joining us again on What Can You Do Right Now weekly workshop, where we are helping you get relevant, practical information that you can apply in your business or in your life today. So last week we talked about reformulating benefits so that you can save money while keeping employees covered. So if you missed that, we'd be happy to share that recording with you. Today we have Susan Klaren, who is a senior loan officer at CMG with us. Susan has been a lender for 16 years and has the heart of a mom and the soul of a teacher. She loves helping families get into homes, stay in their homes, and build true wealth. Today, she's going to be sharing some updates on mortgages, forbearance, self-employed loans, and the market's current status. So Susan, I'm going to kick it over to you.
All right, so I wanted to try and address a couple things that might be of concern, particularly for people that are self-employed. And for those that own homes, one of the hot topics that I think has probably run through anyone's mind is the issue of forbearance. And I think forbearance is a highly misunderstood area. It is not forgiveness. It is not even deferment. It is simply putting off paying your mortgage. And for some people, especially if you're in an industry that's really challenged right now, it may be the only option you have. So let's throw that out there first. It may be just the only thing that you can consider doing, and that's okay. But the space has changed a lot, even in the last 5 or 6 days. The head of the Federal Housing Finance Agency has come out with some changes to the way Fannie Mae and Freddie Mac and the major lending institutions are looking at forbearance. In the past, it's always been a rule that a lender must have a 12-month mortgage rating. And if your loan is in forbearance, you have to bring it current. And then after that 12 months of it being current, you can actually have an option to buy or refinance or do anything along those lines. And since we're headed into a really great rate climate where a lot of people will be considering refinancing, because rates are going to be that good that you'll want to consider refinancing, you don't want to take that off the table as an option. And so a month ago, if you went into forbearance or even talked about forbearance or put your account in a situation to be in forbearance, whether you continue to make payments or not, you could not do anything for 12 months. That has now changed. And it's space that keeps changing and it's getting more favorable for the borrower. And the big thing that's changed is if you put your account in forbearance but you continue to make your payments on time, then the lender doesn't have to consider you having been in forbearance and you can move forward on anything immediately. If in fact you put yourself in forbearance but then you brought it current, the lender has to wait 3 months before we as a lending institution can consider doing anything for you, whether it's to buy or finance. So that's a really big change because before that it was a 12-month wait. So that's really great. Likely that there'll be some other changes that come along the way. And right now, forbearance is an option that's been extended out to June 30th, and foreclosures are suspended right now until June 30th. And it's constantly changing, but that's where it's at as of today. Next slide. We move to the next slide. Thank you. Okay, self-employed mortgage loans. So the first option always for someone who's self-employed is, can we take a look at your tax documents and make a loan work for you? If you're Schedule C, if you're S Corp, if you're just a plain corporation, if you're a partnership, anything that you have 25% or more ownership in, can we take a look at those documents and make numbers work? And the things that we're going to be looking at are bottom line net numbers, but also there's certain things that you write off that I'm able to add back in. And that's really your passive deductions. So it's things like depletion or depreciation. Depreciation is like the greatest thing ever because you get to reduce your taxable income, but I get to add it back in as if it never happened. And that includes if you take mileage, I also get to do depreciation on the mileage. So I can add back in like 25 cents per mile. So those are really nice deductions. And if you're thinking you might want to buy or do something in the next 12 months, if you haven't filed your tax returns yet, you could go back and take a look at how you're filing them and maybe pay a little bit more in taxes this year in order to allow yourself to be able to qualify full documentation loans to be able to move forward. So it's something to take a look at. It's something to discuss with your CPA in terms of how much you really need to deduct. The other thing that you might want to really take a close look at is when I run your credit and I'm looking at how much debt you have, those debts that are showing up on your personal credit report, is your company paying them? And if your company is paying them, I don't have to count them, but I do need 12 months canceled checks out of your business account that shows that the company is paying it. It's not enough for me to get a ledger or anything from your bookkeeper. It's got to be 12 months canceled checks out of your business account. And then I don't have to count that against you. So that's another way to set yourself up for success for being able to buy full doc loan. But let's say you're taking full advantage of the last bastion of opportunity in this country to really be an entrepreneur and not have to pay a lot in taxes, and you are writing off stuff, and your tax returns are just not going to show enough income to support what you want to do in terms of a purchase. Then we can start looking at loan programs that are considered non-QM loans. And that might be the next slide. Yes. And those loans are typically bank statement loans. So this is an area that when March 8th hit, by March 15th, all of these types of loan programs were taken off the table and frozen for 30 days. They're now starting to come back, but they're coming back slowly. And so right now, there's some options out there, but you've got to come in with some skin in the game. Right now, you need to have at least 40% down. You've got to have 60% loan to value. It's moving next week. It's probably going to be 30%, just based on the conversations I've been having with wholesale lenders. But you're going to need to have some money coming in. You can't do 10% down, which was an option for a while for something. And what's going to happen is we're going to look at 12 months or 24 months of your deposits in your account. Could be a personal account or a business account, but can't be both. But we're going to look at those deposits. We're going to average them, and we're going to do what's in your best interest, whether it's 12 months or 24 months, however it averages out best. But that's what we're going to be looking at are the deposits, not looking at the tax returns, not worrying about that. And the minimum FICO score right now for those programs is 680. So that's also been a big change. And those loans can go as high as $2 million. So they're a little trickier, but it is space that's available, and it's changing. And that's a space that's going to continue to change for quite a while. And my last conversation with you is, where are rates headed? And the answer to that is, there's no slide on it, but the answer to that is rates are going down. Everything in my industry that you're reading right now talks about rates going down. And it's two-pronged. It's first, where the economy is at and where the economy is likely to be as we come out of this and we recover. We're going to recover probably a bit slowly. That's not great for most things, but it is good for interest rates. So rates are likely to continue to stay low and go lower. But the Feds are also talking about intervening and creating kind of a cap on what can happen with rates. That's still space that's being discussed. But you'll see rates continue to stay in this kind of low climate with some weird fluctuations happening because there's not a lot of consistency with what's happening, and that's where the Fed is trying to come in and balance it out. But if you're looking at making a purchase anytime in the future, or you're looking at refinancing, rates are likely to continue to be low. Rates are likely to continue to go down. The big thing to take a look at and to think about is, as we've seen, the world is changing a lot. And so while rates will continue, I think, to go down, loan program guidelines are going to continue to change depending on what's happening with the market. And so it's kind of a bird in the hand versus two in the bush. If you're able to do something now and it makes sense, then you probably should do it now. If 6 months from now things are better and you can do something even better, okay, that's awesome. But at least you were able to shore something up. But if things change and loan programs change and you're not able to do something, you'll be glad that you did something now. So that's it for me.
Awesome. Well, thank you, Susan, for sharing kind of some of those updates. Sorry for all the technical difficulties, but we'll get things sorted. So first up, I want to open it up to other people, to anyone who has questions. I know I still have a bunch of questions, but I want to let you guys ask your questions first. So just kind of give me a wave to let me know that you have one, and then I'll just kind of direct that to, hey, Ed, let's go with you first.
All right. Okay. Susan, how low do you think the rates will go?
I think we're likely, well, I don't know where exactly they'll bottom out at, but I think probably in the 2s would be my guess. Right now, our 15-year loans, depending on loan to value and credit, are already in the 2s. And you're seeing 30 years dip into the 2s a bit if you're got a lot of stipulations on it, and actually being self-employed is one of the things that is not in favor of how some of the pricing lays itself out. But I think you'll start to see regular, normal stuff that even self-employed people can get going down into the 2s. I think it's going to be a little time before we get there, but I think we're definitely headed there. And I don't see it going below the 2s, but I think we'll see it solidly in the 2s for everybody on a 30-year. My prediction.
Great.
So.
Crazy. Okay, I'm going to go first to Dr. Ellie, and then I'll pop over to Jill.
Okay, Susan, hi. Do you foresee the value of the houses going down?
So that's an awesome question. And that goes back to the bird in the hand versus 2 in the bush, because that's one of the trickier things, right? I think we're going to see values continue to stay where they're at right now, and maybe even increase a little bit as there's some pent-up demand. But I think once we get through summer, I think we're going to see a lot of the effects of people not being able to go back to full employment and income levels where they were at. And I think you'll see people not necessarily losing their homes because they've got equity, but selling their homes and moving out of state or moving into something smaller. And I think that's going to drive the market down some. So I think that's a really great question, because I do think in the next 12 months, we're going to see prices go down. And so if you're looking to refinance, that may impact on it. If you're looking to purchase, well, good news. You might be able to pick something up for a better price than what you would get today. Do I think we're going to see 2008 values? No, you don't have crazy loan programs out there where people just had to breathe and have a pulse to be able to get a loan. That's not good. So you're not going to see loans implode, and you've got people sitting on equity. So you'll see people sell before they end up getting foreclosed on. But I do think you're going to see values going down. Probably 10 to 15% would be my guess.
Thank you.
We got a question in the chat from Vicky asking if it's a good time to buy. I think this kind of goes back to the bird in the hand situation, but you can expound on that if you can.
I think it's kind of personal, right? It's a personal decision about your circumstances, but here's always been my stand on a primary residence. If you're buying a home is a home. It's not an investment. Now in California, for those of us, you know, the amount of increase in value and appreciation has been unbelievable. But really, if you bought a home in almost any other state, you don't buy thinking that you're going to double or triple the amount of equity that you have. It's very rare. So I think you have to look at it realistically. If you can buy a home and you have a 30-year fixed rate payment that isn't going to blow up on you and isn't going to do anything crazy, and you have income that's stable enough to sustain it, then the whole world can fall apart around you, as it has, and it won't really matter because you're stable with this payment that you can make in a neighborhood that you want to be in. I think if you're buying now, you want to buy thinking, okay, is this a place I can stay in for the next, 5 to 10 years? If the market does do something funny and I'm stuck, can I hold on to this property? Can I see myself in it? Can I grow with my family? Can my life change? Would it make a good rental if I needed to move out of state? If you're going to buy, you want to buy with the idea of holding and the idea that maybe not making a lot of money on it right now, but it's going to be a place of safety and a place where you can really feel comfortable and love living. And I think that's really the key thing. So under those circumstances, yes, I think it's a good time to buy. You know, if you can find something that fits that criteria.
Well, and right now, unlike any other time, you also want to think about, is this a place I could see myself being quarantined?
Right.
Is there enough room to be quarantined with all of my family without any of us getting domestic violence calls on us?
Right,
So,
there's that. And does it have a wine cellar? Because that could be really important.
And if it has a wine cellar, bonus.
But yeah, there's all of those factors, and partner that with the fact that rents are definitely going up in the state of California. So, you know, you stave off that increase by having a fixed rate that isn't going to surprise you or do anything crazy. So,
Speaking of that, I rent, and we have a really great rate for where we are and what we get. And like, I've never seen as good a rate for half as nice a place. Would you recommend just kind of sticking with that and holding out and trying to just continue saving and waiting to buy until it makes more sense? Or is it always just, if you can, you should?
Again, it goes back to your personal circumstances. If you have, you know, if you own a home, you're now responsible for repairs, right? So you've got the maintenance, the upkeep, and sometimes unpleasant surprises related to things that happen in your home. So there's always that where you don't have someone to call and have them just come and fix it. But I also think if you're able, you know, if you're able to rent and save money, and like, let's say you're renting for $900 and you're able to put aside $500 a month and save towards the property, then you also know that you could afford a mortgage payment of $2,400 to $2,600 because you're going to have some tax benefits. And you know that you can do that pretty easily if you've been able to save that money moving forward. So I think some of that is about where you're at and what makes sense. But I think it's never a bad idea to be looking at what inventory is out there and what's happening with the market if you have a desire to buy. But I don't think everybody needs to be a homeowner. I don't think that's a critical thing for somebody's happiness. I think it really is, you know, how important is it to you, and you know, how much do you want to stay in one place and know that that place is yours. So.
Cool. Anybody else with, Amy, did you have one?
Yes. So if you took forbearance, but then you continued making your payments, what happens? How's that treated?
At this moment in time, it has no negative impact on you. As of today. A week ago, it would have. As of today,
what would the reason to do that be?
So they're finding that 70% of people that took forbearance didn't need to take it. And it's, you know, it's people sticking money in the bank and, you know, holding on to it if they're not continuing to make their payment. If they took it and they are continuing to make their payment, they're hedging their bets, right? They're thinking, well, I'm okay right now and today, but maybe in a month I'm not going to be, or maybe in 2 months. In some cases, it might be somebody who is still fully employed, but is anticipating that, you know, they might get laid off or put on deferment or whatever that is. So I think it's cautionary. If it's not going to have a negative impact on you and you can have it, it's the same reason people get home equity lines, but they don't tap them. You know, it's just a backup safety net just in case. And I think that's the kind of mentality that's going with it. And now there's no consequence for it, you know, at this particular moment. So, you know.
So they're kind of just requesting it now just in case I need it, just so that I know that it's set up if I have to stop making my payments.
Right.
Got it.
I have several family members who recently refinanced when the interest rates started declining, and they were like, okay, now I'm going to refinance and make sure that, you know, my interest rate's as low as it could be. What does that look like in terms of forbearance as well?
So I'm not sure I understand the question. Are they planning on going into forbearance, or?
Well, what
Not
are their
sure that-
options? Like if you, like, is there a window in which you can have refinanced and still get forbearance, or is there a certain amount of?
No, there's no barrier. There's no barrier to going into forbearance if you've refinanced. However, there's a penalty to the lender that did the refinancing and probably to the loan officer that did the refinancing. If you don't make that first mortgage payment after you've refinanced or purchased, either one, they'll take the commission away from the loan officer, and the mortgage or bank or whoever did the loan pays a very sizable penalty back to Fannie, Freddie, wherever the money came from, the wholesale lender, wherever the money came from. There's a sizable penalty on that. And that's one of the reasons why you're seeing lenders be very cautious in terms of what they're doing. And it's also why you're seeing some lenders control how much activity they're getting by maybe not offering the lowest rates. You know, they're not always necessarily reflecting low rates because they're very cautionary. For example, some of the big banks, I won't name which ones, but some of the big banks won't touch anyone who doesn't have at least a 700 credit score and at least 20% equity. They won't do anything with them at all. They won't do cash out refi on certain situations. Certain situations they don't want to deal with self-employed borrowers for various reasons. Even in terms of prior to closing the loan, we verify income at the beginning, but as soon as 5 days, it has to be within 5 days of closing, we have to go back and re-verify that you're still employed. Some lenders have to do it the day that you close. That's their overlay that says, we're not going to fund unless we can get verification that day that you still have a job. So it's really changing because of real concern over liquidity in the market and the ability to go and lend more loans and borrow more money, and how the cash flows and the stableness of companies. So, good question.
Got it. Thanks, Susan. Lois, did you have a question? I want to say you waved. Okay, cool.
Would it be wise to refinance a 30-year fixed loan to a 15-year, given the interest rate is a lot lower, and if you come out to a closer payment?
So it's case by case, and it's situation by situation. Sometimes getting a lower rate doesn't necessarily make sense. It depends on what your long-term goals are. If your goal is to have the house paid off before you retire, for example, maybe it makes sense to do a 15-year and speed it up. I have some clients recently who we looked at doing a 15-year and giving them a lower payment, but we figured out that they could amortize the loan themselves by putting it's about $500 more a month against the payment they currently had. And when you compared apples to apples, they only shaved off like an extra year by taking a 15-year compared to amortizing it themselves. And amortizing it themselves, they were able to control their own cash flow. So maybe if they had a bad month or they wanted to do something special, they had $500 extra to be able to do that. Where if they had the 15-year loan and they were obligated to make that 15-year payment, they didn't have the option of being able to cash flow. So it's really case by case and situation by situation based on what are your long-term goals. It's kind of Stephen Covey, begin with the end in mind, you know, where are you headed with it? What's your long-term goal? And then how do you manage this asset and this debt in a way that makes sense for what those long-term goals are? And so where an asset manager is really looking at how do we take your income and all of your profits and do things that are really wise with it. What I'm looking at is how do we structure your long-term debt in a way that makes sense, that you can leverage it, because money is stupid, crazy cheap right now, that you can leverage it in a way that makes sense for your long-term goals that are, you know, to help you achieve what you want to do. So it might not be logical to somebody else, but when we look at the overall picture of what you're trying to do, it makes a lot of sense. We really look at cash flow and long-term places and what you want to do with money and that kind of thing.
Okay, great. Thank you.
Love it. Well, hey, I just realized that we are at time. But Susan, if you don't mind hanging out and continuing to answer questions, we can
Sure.
definitely do that. For anyone that does need to jump off, you can feel free to do that. I want to highlight really quickly Susan's contact information. If you have more questions for her, or if you want to reach out to her directly, one of the things that she does, which I love, is that if you just have your current mortgage statement, she can help you by taking a look at that, seeing if there's an option that might work for you or might help you without running your credit. So you don't need, it's not like a hard look at things. It's just like, hey, why don't we take a look at this? If I can do something, then we'll continue and we'll do those kinds of things. But if I can't, then we won't do any of that. So that's one of the things I love. If you want to reach out to Susan directly, here is her contact information. And then next week, we are going to have Jim Moises at Link Business Brokers talking about how to run a business that you could always sell, which I think is a great thing to be thinking about right now, as business for some people is a little bit slower. It could be a great time to start looking at how you are running and structuring your business so that it is always sellable. So I'm excited for that one next week. I'm gonna geek out about that.